What's up traders, let's speak about the TL-TCL strategy. Now the first thing we have to define is that what is the TL-TCL strategy. Now the first thing is that TL stands for trend line. So basically the first thing we will need is a trend line. Now by definition, when you have a trend line, you basically have the market that is hitting a particular level. Now you need at least two highs to draw a bearish trend line, and you need at least two lows to draw a bullish trend line, and that we have already spoken about it in the introduction section. Now what we will do, we will be using both weekly and daily time frame trend lines to understand when we're supposed to enter the market. Now obviously take profit will be as in the case of the ICI strategy. So basically the TL-TCL strategy is just a generalization and a better moment in which you're supposed to apply the ICI strategy. So basically you have more confirmation that yes, the market made an impulse to the downside, went to a trend line, and we're expecting another push to the downside. So basically we have an impulse correction and again another impulse. Now what CTL stands for, because we know that we said the strategy is called TL-TCL. So TL is trend line, CTL is counter trend line. What is a counter trend line? A counter trend line is a trend line that there is when the market makes an impulse to the downside, goes with a correction, and basically you can draw a trend line on this correction. And why it is a counter trend line? Because at some point the trend line will break, and that is when you're interested in selling. You will not buy the bounce of the trend line, like in this particular case, in which you're interested in buying from here. In this case, you're interested in selling from here. And in this case, again, you're interested in selling from here. So in a normal trend line, like a bearish trend line and a bullish trend line, you're interested in buying the bounce of the trend line. Here with the counter trend line, so the definition, you first have an impulse to the downside and the trend line is taken on the correction of the previous impulse, then you're interested in selling after the trend line has broken. Now let's go and find some examples both on the weekly and on the 4-hour time frame. Now let's get some price action. So here we are on the weekly time frame. Now the first thing, for example, we can immediately recognize that if we take a trend line from this high in this way, as I have taught you, because most traders, as I have taught you, will take the trend line this way, so from this high to this high here, and they will have no touch here, so they won't know what to do. You know how to take the trend line in the best way possible, so basically in this way, touching 3 candles here. And if you do this, you immediately recognize that the market is rejecting this area. So what you will do, you know that you have 3 touches on a trend line, you have 2 touches, we could have the 3rd touch. The market has already touched it on the weekly time frame. So what we do, you already know it. You go on the 4-hour time frame and you look for a shift in momentum. It's the exact same thing every time when it comes to entry. You go, you bring your indicators, and you're waiting for a shift in momentum. As you can see, at the moment everything is extremely bullish, so you're not interested in the pair at the moment. Now everything is still bullish. Now this is the first time that the market shifts to the downside. You can see that now the MACD is below the 0 and EMAs have crossed and the market is a bearish trend. Now if you look at the numbers, the price is 132.72. Now what this means is that you can take short in between the 80 and 95 area. So basically this box here. And you will also have this trend line to protect your stop loss that must be above this structure. Your stop loss must be above this high to be 100% sure that if it hits, the market has created a higher high. So we can take short inside of this box. Let's take short from 95, since we can expect the market to make a retest before continuing to the downside. Stop loss will be above this area. Now what about our take profit? Where can we put our take profit? The answer would be very simple. If you zoom out, you will realize that we expect the market after we hit the trend line to create a lower low. So if the market will go to create a lower low, it means that the market needs basically to make all of this impulse to the downside and break below this low. Now to break below this low, what it means is that we can take, if the market basically wants to create a lower low, what we can do is we can use the fact that we know that the market is supposed to create a lower low and take our Fibonacci on the previous leg, which in this case will be from this high to this low, because this is the previous leg on the weekly time frame. If now the market is supposed to create a lower low, this will be the previous leg. It's always the same concept. There is no need to go on the weekly time frame to identify it. So once we know that this is the previous leg, our take profit will be at the first strong number above the minus 27. We already know it. So if the minus 27 is 108.34, our take profit will be 128.50. So this will be our take profit. And we can immediately see that we have 1 to 4.50. Now let's see what happened. The market already triggered our order. We have a slippage against us. The market is moving against us, but we know that until the market basically goes to our stop loss, so basically above this high, the market is still in a bearish trend. Why do I say this? Because we have a high here, and we basically, until the market will create a higher high, then we will be perfectly fine. Now the market is impulsing to the upside, however it never reached our stop loss. We still are break even. And now this is basically the moment in which you're supposed to go risk-free. So again, the market is still moving near our entry. Now we got the first break to the downside. The market is pushing, and take profit is almost hit. Okay, take profit is hit. So as you can see, we had a nice swing. Now we had a lot of drawdown, it's true, but who cares? We know that our stop loss is above the structure, so if it gets hit, then it means the market has created a higher high, and we have high probabilities that their trade, basically that the setup won't work anymore. So everything was basically perfectly according to the plan. Now let's see what is going on. Let's make another example. Actually, we can immediately make another example here on the weekly time frame, so the concept will be clear. If we just extend this trend line, so now we have 3 touches, and when a trend line has 3 touches, then it means that basically the trend line itself is confirmed. Now, what do I mean that is confirmed? Basically that we have a high probability that the market will shift away from a trend line if it's touching it for the 4th time. The 3rd time that the market touches a trend line is usually a little more risky, but if the market respects it 3 times, then it's a confirmed trend line. It's confirmed that this is a very important level in the market. So once we know, let's use the reply tool, that the market is rejecting this level, you already know that you're looking for shorts. You already know you have basically a touch of your trend line, you're looking for shorts, and what you also know is that you already know your target. Because what will be your target if now the market starts the push to the downside? You already know it. You will just take your Fibonacci from this high to this low, and you can do this also on the 4-hour time frame. It will be the exact same leg, and your take profit will be the first strong number above the minus 27, which in this case is 124.80. So moving down on the 4-hour, as usual, we will be looking for a valid entry. We will be bringing our indicators. You already know exactly what we're supposed to do. We do this each and every time in the exact same way, and we will wait for a shift in momentum. So now we just got a shift in momentum. The market has broken below the MACD, 10 EMAs below the 20, everything is pushing to the downside. Now where is our previous support now turn resistance? Is exactly here. As you can see, we can put a horizontal array on it. The market had found support around this area, and now we're expecting it to be resistance. So let's put our sell limit at this order. Basically, let's now look, we have our sell limit there. let's look at the structure. The market goes down, up, down. So where will be basically the high above which I want to put my stop loss? Very simple. My level at which I want to put my stop loss is above this high. So let's put our stop loss above this high. Now the best way to do this is to look where is the first strong number above the high, and you can see that the first strong number is 131.20. So we want to put our stop loss, let's say 5 pips above the first strong number above the high, because in this case this is already a very small stop loss. So if we put it up there, we give our trade more air and it's perfectly fine. We already have identified our take profit from the weekly time frame. As I already said, we could have done it in the exact same way just by taking our Fibonacci in this way, which is the exact leg we already took on the weekly time frame. And let's see if our order gets triggered. So our order gets immediately triggered. Let's see if we get drawdown. Seems we're getting some drawdown, but then the market shifts to the downside, and now you're supposed to go risk free. You got a big push to the downside, and it seems the market is pushing to our take profit. At this point, guys, I would have exited the market before my take profit was hit because I had a rejection. So if you are near to your take profit and the market starts a rejection to the upside, just close out the position. You already have a 1 to 6.86. Close out the position. You made much more than you need. So we have a 1 to 6 again. Now the concept of trend lines on the weekly time frame is pretty clear. It's the exact same concept as for any kind of strategy that we use. We just identify the trend line and then we drop on the 4 hours to take our entry. Very simple. And our take profit is just it taken at the first strong number above the minus 27 of the previous leg. What about the daily time frame? Exact same concept, but you're doing it on the daily time frame. Let's see if I see a good trend line on the daily time frame. Maybe here. Seems here we have a good trend line. So you can immediately see that if you take your trend line from this high, touching as many candles as possible here, in this way, you're basically getting a strong level of resistance around here. Plus, you have a nice W formation. So basically, we don't need real indicators yet. So basically, let's see how we're supposed to take our entry here in the exact same way as for the weekly ICI strategy. So we know that the market, and in the same way also as the trend line strategy on the weekly time frame, we know that the market has just hit an important trend line from the daily time frame. So what we're supposed to do is drop on the 4 hour time frame and perfect our entry. What about take profit? Take profit is just in the exact same way as the weekly time, as basically the weekly example we have just made. If we are expecting the market to create a lower low, our take profit will be at the first strong number above the minus 27 of this previous leg. So let's take our Fibonacci from the high to the low, and the first strong number above the minus 27 will be 137.50, because here we have 30, the first strong number above is 50. So we have our take profit. Let's go on the 4 hour time frame and let's see when we get basically a break of structure in our favor and the momentum to shift in our favor. Now at the moment everything is still bullish, as you can see. Everything is still bullish. Now this is the first time that the momentum shifts to the downside. As you can see, now the MACD is below the 0. 10 EMA crossed below the 20 EMA. Perfect. We can now delete all indicators because we know that we are in a bearish market. Now if you take your entry from here, you're basically inside the 50-65 area, as you can see. So we can take short immediately from here because everything has just crossed to the downside. We already know our take profit from the daily time frame, and we already see that the market has created a high here. So what we can do is just put our stop loss with some air above this high. Why so much? Why do I want to put my stop loss at such a big distance? Because anyway, I have a 1, 2, 3. I have a 1, 2, 3, so I'm perfectly fine. And if the market will go a little bit above, just to hunt the stops that are placed just above this high, I don't wanna basically have that risk. Why? Because I can. I have 1, 2, 3. So why put a tight stop loss if I already have my minimum 1, 2, 3 risk to reward? There is no need. Let's see if the market will make will basically hunt the stops that are above here. Maybe now? No. So basically now you're supposed to go risk-free. The market has moved way below your entry, and the market never really went to hunt the stops. Now the market took us out break-even just now. So what you're supposed to do once you get out of a trade break-even, we already spoke about this. We need to see if something has changed in the market. Has the market changed environment? Yes or no? We already know that the market overall is supposed to go to our target, but we need to reevaluate again, is the market in a bullish or in a bearish environment? Now MACD is still below the 0, the 10 is still below the 20, so everything is still pushing to the downside. Let's see if this was just a fake. So as you can see, now the market has broken back below the EMAs. This was a break-even trade. We can take short again. Now why can we take short again? Because the market has broken again the structure. The market went down, pullback, broke the structure to the downside. EMAs have a lot of distance, MACD is below the 0, the market is overall in a bearish environment. So again, we have another break of structure entry scenario. Now what will change is that we have some different numbers in this case, because as you can see, the market is not in the 50-65 area anymore. So what we can do basically is take short, because we can see that the market has already hit 35, which is the slippage number of 20. So we are in the 20-35 area. So we can just take short, put our stop loss above this high. We know that the market has resistance at this green candle here. We can just put our stop loss according to the rules above the high. That is also above the 50 and 65. What do I mean by this? Is that basically if you now take short from here, because you know that everything is still bearish, and nothing has really changed technically, this could have easily been just a fake move. What you know is that 50-65 is your strong area. So if you put your stop loss above here, you basically have your stop loss above the strong area. So even if the market wants to go and retest this green candle here, your stop loss will be perfectly fine. And if the market actually makes it all the way here, then it means that probably the momentum is shifted to the upside and you're happy to be out of the trade. What about the take profit? Take profit obviously is exactly the same. Nothing changed with your take profit. Now you have 1, 2, 3. You can just see that by taking it 1 pip below, you have 1, 2, 3. So perfect. Your stop loss is protected. Your entry is good because nothing has changed and everything is still bearish as we have just seen. So as you can see, this move was just a fake. The market just the next candle we were already risk-free and the market hits our entry. I want to see what happens next. Okay, so the market accelerated after touching our stop loss. Perfect. So as you can see, daily and weekly trend lines is the exact same strategy. Nothing really changes. I want to find at least an example for a counter trend line. I want to show you the concept. Okay, so I immediately see one. So as you can see, I just have to look for an impulse. If you want to find a counter trend line, you just have to look for an impulse. That is how you know that you have a counter trend line and not a regular trend line. What I mean by this is that as I have explained you, with a counter trend line, you have an impulse, the market makes a retracement, and you have a trend line on this retracement. And basically, you're not interested in buying this trend line, but you're interested in when the market will actually break this trend line, and then you can take it to the downside. So, where is the trend line in this case? Very simple. This is how the trend line is basically holding the market. So we are waiting for at least one daily candle to break below this trend line, and then we will go on the 4 hours to take the entry. It's always the same. With a counter trend line, you wait for the market to break it. With a normal trend line, you just wait for the market to touch it. Like in this case, if this was a regular trend line, we would have been already interested in longs, and we will be on the 4 hours looking for longs. But in this case, we want to see a break, and then we want to see the market continue its push to the downside. So as you can see, the market has just closed below the trend line, so we can go on the 4 hour time frame and see if the market has already changed environment. So as you can see, we have already shifted to a bearish environment. MACD is way below the 0, and 10 EMA is below the 20. So what does it mean? We can already be looking for shorts. We had left shoulder, head, and the market was supposed to create right shoulder here. However, the market failed to do that and just collapsed below. So what we should do in this scenario, we can just take short because the market has broke the structure. It's a simple break of structure entry in a market that is completely in a bearish trend. Our stop loss, we already know it. It will be above the high. What about our strong numbers? We can just look at the price. What kind of prices we have? 76, very simply, it's 80. And what is the stop loss number of 80? Basically, the slippage number is 95. So this will be the scenario. Our stop loss is way above. We have our strong number, especially because this is a very volatile pair. What about our take profit? We already know it. If this is what we expect from the market to create a lower low, this will be the previous leg, the lowest low to the highest high. So let's just take our Fibonacci from the highest high to the lowest low, and our take profit, as usual, will be at the first strong number above the -27. And as you can see, this is 128.50. So this will overall be the trade. We have our take profit. We know that our stop loss is basically well placed. We don't need indicators anymore because we already know that basically the momentum is bearish, and this is overall what we have. So we have immediately some drawdown, again some drawdown. We know that until the market will remain below this high, we will be perfectly fine. And if the market does make it above this high, then overall the market has created a higher high, so we have a good probabilities that the market will continue to the upside, and we are happy to be out of the trade. So the market is stuck after our entry. Okay, this is the first push to the downside that we get. However, we still need either the market to make another big red candle, or the market to make some kind of retracement and then continuation before we can go risk-free. Okay, this is exactly the moment in which we go risk-free. As you can see, the market has went down, up, down. So again, if now the market goes up above this high and also above this high and take us out, then it means that the market has created a higher high and we have good probabilities for continuation to the upside. So it's perfectly fine to go break even at this point. We are break even on the trade. We're not risking anything. Let's see if take profit hits. So at this, okay, perfect. I was about to say that if this point the market went nearer to my take profit and then started rejecting, I would have just closed out the position, as you guys know. Because even if you close out your position around this area here, if the market is starting to reject, you already have 1.4.8, which is way more than you need. But as you can see, you have no rejection and the market just goes straight to your take profit. So the concept is extremely clear. It's the same for any kind of trend line, as we said in the beginning. If you have a bullish or bearish trend line, as you have just seen, you will just wait for a touch either on the weekly or on the daily time frame of this trend line, and then you will drop on the 4-hour time frame to find one of our valid entries. Same thing for a bullish trend line. In the case of a previous impulse to the downside and a trend line that is taken on the retracement, so basically a counter trend line, you will wait for one daily candle to close below, go for a retracement, and once basically the market closes with one red candle to the downside, at that point you go on the 4 hours and you look for one of our valid entries. Extremely simple concept.